Hi there. Welcome to the 10-Minute Analyst, where we turn complex institutional research into intelligence you can actually use.
Every week, we dissect the latest reports from banks, summarizing the charts, the data, and the bottom line into a concise podcast and visual deck.
It's open source intelligence for the modern professional. Now let's dive in.
Today, we are doing a bit of time travel, we're freezing time right where we are. It is mid-February 2026.
Yep.
And if you're an investor looking at the Chinese internet sector, specifically the big index, the KWEB, you might be scratching your head a little bit.
It definitely looks a bit lackluster at first glance, doesn't it?
Lackluster is a polite way to put it.
Right.
I pulled up the charts this morning expecting fireworks after the Chinese New Year and, well, nothing.
Flat.
Just flat. The whole sector looks like it's taking a nap. But you sent over this stack of research that suggests something completely different is going on underneath the hood. You're calling it a brawl.
A brawl. It is absolutely a brawl. If you zoom in past that index level and you look at the individual companies, specifically the two heavyweights, Tencent and Alibaba, they are tearing each other apart.
Wow.
It's a fierce battle for AI dominance, and it's creating this massive divergence in their stock prices.
Okay, so walk me through this divergence. Because usually these two kind of move in sync. When China tech goes up, they both go up.
Not this year. It's really a tale of two giants right now. On one side, you have Alibaba. Their stock is actually performing quite well. They're outperforming the broader sector. The market is loving their story right now.
And the story is AI.
Specifically, it's a strategy called Agentic AI, and we'll get into what that means in a minute. But yeah, the market sees Alibaba as the aggressor here.
Okay, so Alibaba is the golden child. What about Tencent? I looked at their chart and it's red.
Deep red, down about 9% year to date. The narrative on the street is that Tencent is the laggard. Investors are worried they have a chatbot problem.
A chatbot problem. Tencent, the company that owns WeChat. That just seems hard to believe.
It does, but that's the perception. And, the mission of this deep dive is to figure out if that perception is actually reality.
Yeah.
Because when you dig into the sources, you realize this war isn't just about code. It's about red packets of cash, regulatory yellow flags, and I'm not kidding, millions of cups of free bubble tea.
I saw that in the notes and thought it had to be a typo. We're talking about billion-dollar tech companies fighting a war with boba.
We are,
Yeah.
and it's costing them a fortune.
All right, let's unpack this. We need to figure out who is actually making money here. Is it the flashy AI agent or, the quiet giant? Let's start with the bubble tea.
Let's do it. So to understand this, you have to get the timing. We're looking at data from early February 2026, right around the Chinese New Year.
Which is usually huge for consumption.
Massive. And traditionally, the digital giants use this period to acquire users. In the past, it was digital red packets, literal cash handouts to get people to use payment apps.
Right.
But this year, the battleground shifted to AI chatbots.
So instead of here's $5 to use WeChat Pay, it's here's $5 to talk to my robot.
Exactly. Alibaba, for their model called Qwen, decided to get creative. They launched a massive promotion offering free bubble tea coupons if you downloaded the app and, interacted with the bot.
I would download a lot of things for free bubble tea. Did it work?
In the short term, it worked incredibly well. We call this the sugar high.
Okay.
On February 7th, right at the peak of the holiday, the daily active users, DAUs, for the Qwen app surged to 73.5 million.
73.5 million. That is the population of the UK all logging in on a single day.
It's a staggering number for a standalone AI app.
But I'm guessing there's a but coming.
There is always a but with subsidized growth. The very next day, February 8th, that number dropped to 68 million.
Okay, that's a drop, but 68 million is still a lot of people. What about Tencent? Did they do the boba strategy too?
They stuck to the classics. They used cash handouts, the red packets, for their app, which is called Yuanbao, and they saw a similar spike. Downloads jumped by 10 million in a week. DAUs nearly doubled to 18.3 million. But again, as soon as the holiday ended, usage dropped immediately.
So help me understand the skepticism here. If I'm an investor, shouldn't I be happy? They acquired tens of millions of users in a week. Isn't that the name of the game?
In 2015, yes. Back then, they were fighting for mobile payments. If I give you $5 to link your bank card to WeChat Pay, you're probably going to keep using it because it's a utility. It makes your life easier every day.
Right. Once I'm set up, I'm lazy. I'm not going to switch.
Exactly. But AI search is different. This is about changing behavior. You've probably been using a search engine, Google or Baidu, for 20 years. It's muscle memory.
Hmm.
Just because I gave you a free tea to ask a bot one question doesn't mean you're going to stop Bay doing things tomorrow.
It's a transaction, not a habit.
Precisely. And the data backs this up.
Yeah.
The sources point out that while downloads spiked, the daily activation sessions, basically how often people open the app, are stagnant. And the power users, the people using the bot more than 10 times a day,
Yeah.
they're a rounding error. I mean, compared to a super app like Douyin or WeChat, the engagement on these bots is tiny. People came for the tea, drank it, and left.
That sounds very expensive.
It is incredibly expensive. We'll get to the cost later, but that raises the question, is this sustainable? Or is it just a vanity metric?
So we have this sugar high of users.
Hmm.
But you mentioned earlier that Alibaba's stock is doing well. If the user retention is so questionable, why is the market so excited about Alibaba?
Because Alibaba has managed to sell a very specific vision of the future. They aren't just building a chatbot that writes poems. They're building what we call agentic AI.
Agentic. I keep hearing this buzzword. Break it down for me. What makes an AI agentic?
Think of the difference between, say, a librarian and a butler. A librarian, like a standard chatbot, can find you information. You ask, where can I get a pizza? And it gives you a list of restaurants.
Okay, makes sense.
A butler, an agent, doesn't just give you a list. You say, get me a pepperoni pizza, and the agent goes out, selects the restaurant, places the order, pays for it, and tracks the delivery. It has agency. It does things.
I see. So Alibaba wants Qwen to be the butler.
Exactly. They are pivoting Qwen to handle e-commerce transactions, order food, book travel. They want to integrate it deeply into their whole ecosystem.
That makes sense for Alibaba, right? They are a transaction company. They want you to buy stuff.
It's a strategic necessity for them. I mean, remember, they've been losing ground to Meituan in local services, food delivery, hotel booking.
Right.
Alibaba sees agentic AI as the weapon to win that back. If the AI is the interface and Alibaba owns the AI, they own the customer.
And the technology is actually there. I feel like I've been promised a robot butler for decades.
It's getting close. Their model, the Qwen 3 Max Thinking, is legitimately impressive.
Thinking, that's in the name.
It is. It refers to chain of thought reasoning. It means the AI sort of pauses to reason through a problem before answering, which cuts down on errors. It's currently ranked as a top 10 model globally and the leader in China, so the tech is real.
And I noticed in the notes that their cloud business is finally waking up too.
That's the other pillar of the bull case. AliCloud revenue is growing 30 to 40%. For a long time, that business was just stuck in the mud.
Yeah.
Now, because everyone else needs to train AI models on Alibaba's cloud, they are seeing massive acceleration.
So I get why investors like it. You have a recovering cloud business and this futuristic AI butler.
Right. There is a simple valuation heuristic, a mental model that a lot of experts are using right now. They say, look, the core e-commerce business, Taobao and Tmall, is worth about $100 per share on its own.
Just the online shopping part.
Just the shopping. So if you buy the stock at today's price, you are basically paying for the shopping business and getting the cloud growth and the AI upside for free.
Huh?
It's an option, like a lottery ticket included with your purchase.
That sounds like a no-brainer. But surely there's a risk here. If I tell my AI butler to buy me a shirt, I'm not scrolling through the app right.
You hit the nail on the head. This is the existential risk. E-commerce relies on discovery.
Mm-hmm.
You go to buy socks, you scroll for 10 minutes, see an ad for a blender, and buy that too. That's where the high-margin ad revenue comes from.
And if the butler just buys the sock...
You never see the blender. You never see the ads. So Alibaba is walking a tightrope. They need the agent to be helpful, but if it's too efficient, it might actually cannibalize their advertising revenue. They are potentially destroying the impulse buy.
Fascinating. So Alibaba is betting the farm on this agent strategy. Now let's flip to Tencent. You said they are down 9%. Why? If Alibaba is the agent, what is Tencent?
Tencent is currently being painted as the laggard.
The laggard. Ouch.
It's a narrative problem. Investors look at Qwen, they see the headlines, and then they look at Tencent's app, Yuanbao, and just go, meh.
I read about the Yuanbao party. That sounded awkward.
The Yuanbao party snafu. Yeah, it was an internal event meant to hype up their AI team, and by all accounts, it just fell flat. It felt disjointed. It signaled to the market that maybe Tencent's different divisions aren't talking to each other.
And then there's the WeChat wall.
Mm-hmm.
I saw this in the report. Tencent blocked links to Alibaba's Qwen on WeChat.
They did.
Isn't that just petty? Or is it anti-competitive?
It's definitely defensive. But think about it from Tencent's perspective. They own WeChat. 1.4 billion people use it for everything, talking to grandma, paying bills, reading news.
Right.
The quality bar for putting a feature into WeChat is incredibly high. You can't just shove a beta test AI into that app. If it hallucinates or insults a user, you damage the most valuable social network in the world.
So they're blocking Qwen partly to slow Alibaba down, but also because they just can't afford to be messy.
Exactly. But to an impatient investor, caution looks like fear. It looks like they're behind.
But here's where the deep dive part comes in. The sources you sent argue that this Laggard label is totally wrong. That while everyone is staring at the chatbots, Tencent is actually the one making money.
This is the forest for the trees moment. While Alibaba is winning the headline war, Tencent is quietly winning the bottom line war. They are applying AI to places that aren't flashy but are incredibly profitable.
Like advertising.
Specifically video accounts.
That's their version of TikTok inside WeChat, right?
Correct. And it is booming. Revenue from video accounts surpassed 10 billion RMB in the fourth quarter. And the key here is ad load.
Ad load. That's just showing more ads.
Yes, but you can only show more ads if the AI is good enough to make them relevant. If I show you 10 garbage ads, you quit the app.
Right.
If I show you 10 ads for things you actually want, you keep scrolling. Tencent has used AI to increase their ad load to about 5% without hurting user attention. That is pure high-margin profit driven entirely by better AI algorithms.
So they aren't giving away free bubble tea to get users. They're using AI to squeeze more money out of the users they already have.
Precisely. And don't forget gaming. Delta Force is driving growth there. Despite the weird calendar shifts with Chinese New Year, the gaming business is a cash cow.
So the argument is Tencent is trading at a discount sub 15x PE, which is cheap for them because people are obsessed with the chatbot, ignoring the money machine.
There is a great analogy here with the U.S. tech giants. Remember a few years ago when everyone thought Meta, Facebook was dead?
Oh, yeah. TikTok was going to eat their lunch.
And then everyone thought Google was dead because of ChatGPT. These giants take turns being the laggard. The market punishes them, the stock drops, and then they roar back, they figure it out. The experts believe Tencent is in that penalty box moment right now.
I see.
It's a buying opportunity if you believe they will eventually figure out the chatbot side while banking the ad money in the meantime.
Okay, so we have the agentic aggressor and the profitable laggard. But they don't operate in a vacuum. We have to talk about the government. The report mentions a yellow flag environment. What does that mean?
Think of a racetrack. A red flag means stop, the race is over. That was 2021 with the crackdowns.
Right.
A green flag is go, go, go. A yellow flag means caution. There is debris on the track. Slow down.
What's the debris?
It's a mix of mixed signals. Recently, there were investigations into companies like PDD and Trip.com. There were rumors about a VAT hike, a value-added tax increase that scared the market. The rumors were debunked, but the fear remains.
Feels like investors are constantly waiting for the other shoe to drop.
Exactly. It puts a ceiling on the valuation. Even if Tencent and Alibaba execute perfectly, the market is hesitant to pay a premium because the regulatory temperature is just a bit too warm.
And finally, we have to talk about the bill. All this bubble tea, all these AI agents, all these servers. Who is paying for this?
CapEx, capital expenditures. This is the elephant in the room.
Give me a sense of the scale here.
It is massive, and it's starting to worry investors. In the U.S., we're seeing this with Google, and Amazon investors are getting grumpy about AI cash burn. They are asking, we are spending billions on chips. Where is the profit?
And Alibaba's numbers are stark.
To put it mildly, in a recent quarter, Alibaba's operating cash flow was around 10 billion RMB.
Okay, that's money coming in.
But their CapEx money going out to buy servers, GPUs, build data centers was 31.5 billion RMB.
Wait, they spent 3 times more on hardware than they brought in as cash.
In that quarter, yes. Now, Alibaba has a massive war chest of cash, so they won't go bankrupt. But think about that ratio. You are burning furniture to heat the house. You can't do that forever.
That really contextualizes the bubble tea. If you are burning 30 billion on servers, those 70 million bubble tea users better stick around, or you are digging a very deep hole.
That is the danger of the sugar high. If the users leave when the freebies stop, you are left with a massive bill for servers that no one is using.
So let's wrap this up. We started with a boring stock chart, but we found a brawl underneath.
We did. It's a merry-go-round. On one horse, you have Alibaba winning the headlines, spending aggressively, betting the farm on the AI agent.
And on the other horse, Tencent winning the bottom line, quietly printing ad money, but suffering from a serious image problem.
And swirling around them is regulatory uncertainty and a fire pit of cash burn.
It really is a battle of bubble tea versus ROI.
That's the perfect way to frame it.
So here's the question I want to leave our listeners with today.
Mm.
If you had to place a bet on this merry-go-round, which ticket do you buy? Do you go for the company that is dazzling you with new tech and free boba promising to change how you live?
Or do you bet on the one that is quietly using that same tech to make its money printing machine just 5% more efficient, even if they look uncool doing it?
And perhaps the darker question, how long will shareholders let this cash burn continue before they demand the music stops? Something to chew on with your next bubble tea. Thanks for listening to The Deep Dive. We'll see you next time.